Hello, everybody, and welcome to the monthly market memo for the month of March 2026. I'm Case Eichenberger, the Chief Investment Officer with RetirePath Advisors, and in today's short video, we wanted to walk through some of the key headlines that shaped our markets for the month of March and get into a little bit of an outlook for the next couple months of April and May as we get into summer, the summer part of the year. So, without further delay, let's go ahead and jump into it. As we always do, we like to really start with just the returns for the month and for the year and see kind of where we sit right now. Markets did take a breather in March. As I recorded February's video, we talked just a little bit at the beginning about the conflict in Iran and the Middle East that was just beginning back in at the end of February. And come here at the end of March, really that's what caused a lot of the volatility. Markets did take a breather. In March, stocks fell 5% or more, depending on what asset class you're looking at. And here I'm going to paint that picture for you. As you see, the S&P 500, which I'm highlighting here, was down about 5%, right on the dot almost, for the month of March. Small and mid cap stocks also down about 5%. Overseas stocks fared worse as they are much more energy dependent upon the Middle East, upon ships coming through the Strait of Hormuz, which we'll talk about here in a little bit. They were down 11. Bonds were down a little bit, fared better though than stocks, down 2, and of course cash was still positive. So, um, yeah, even though stocks were down 5%, an asset allocation mix of stocks and bonds, with a little bit in bonds, if you do have that, definitely helps you manage your risk a little bit better in the month of March. So, what really, where do we sit for the year? Stocks in the S&P 500 are still down a little bit, right around 4%. Small and mid cap stocks are actually marginally positive, and international stocks are just a touch below negative there. So, still pretty mixed markets here for 2026 as we just finished the first quarter. Bonds are about flat, cash is positive. We do expect much more positive markets for the rest of the year that should push us into positive territory, but I'll get into that outlook here in just a little bit. So, what were some of the key themes? Obviously, the conflict, in Iran and in the Middle East is now just over a month old. Is it nearing an end? We do believe it is nearing an end. Just on the last day of the month, actually, stock markets were very positive as the U.S. came out and said, we're willing to end this war, get out of this war, and without the Strait of Hormuz really opening, once we're out, the Strait will open, is what President Trump said. Then you also had the president of Iran come out and say something similar. Is once they everybody can agree to a deal here, they're definitely wanting to stop aggressions as well in the Middle East. So that caused stocks to move materially higher on the last day of the month of March. We do believe we're nearing an end. But regardless, there was a lot of volatility in March. Let's talk about the Strait of Hormuz just a little bit. It is just a narrow strip of water where a lot of tankers move from west to east to move barrels of oil that is used for fertilizer, fueling. It's also moving natural gas into Asia and Europe. And about one out of every 5 barrels of oil that is consumed every single day comes through the Strait of Hormuz directly. So as you can see, we're highlighting here, there's about 20 or 21 million barrels per day that comes through the strait, much more than any other significant kind of choke point in the world, and it is a very much in focus right now. Now, really, what has happened since the war started is we've seen about maybe 200 or so 7-day cumulative ships go through the Strait of Hormuz, and it really just fell off a cliff. Once the war started, the Iranians effectively said the strait is closed. We may deploy mines. If you try to cross, we will try to shoot down your ships. So it just wasn't worth it for a lot of these ships to go through and potentially get damaged and sink or whatever may happen there. So a lot of ships just stayed out of the way, and there's a lot of oil kind of trapped on the wrong side of the world where everybody needs to get through that strait to get their oil. So that's where you've seen really a lot of the volatility happen is what is around oil and what is happening over in the Strait of Hormuz. the effective closure of the strait has really pushed the price of oil higher. This is maybe a little bit delayed, but you can really see that global Brent oil and US WTI oil, which is West Texas Intermediate crude oil, is right around 90 to $100 a barrel. Brent is around maybe 110 to 120 right now. So you've seen just the price of oil skyrocket. And in turn, of course, if you're filling up your car, if you're looking at the gas tank and you need to go to the gas pump, gas prices have materially moved higher here for the month of March, up close to $4 a gallon. Some say it's up over $1 than where it was last year. Definitely up over $1 than where the low was to begin the year. So a lot of volatility in the Middle East caused oil to go up, caused gas prices to go up, which we've definitely seen here in the U.S. at the pump, no matter what. Now, the good news is the U.S. is much more energy independent of Middle East oil than we were back maybe in the 70s when the oil embargo was happening. The U.S. actually produces the most amount of oil in the world. We are right around 20 million barrels of oil per day being produced. That's almost double the second place of Saudi Arabia. So we are really more independent and can handle these types of shocks a lot better than what we used to. On the other side, we also are spending a lot less on energy. I'm painting this picture here from the 50s up to the 2024s, where we were right around 42% of our household spend was going towards energy and energy related products. Right now, we're around 24%. So just much less being spent and much more energy independent. Put those two things together, that means the stock market really didn't sell off that much. It was down maybe 9 or 10%. At the lows, we're much better than that right now as I record this. And the recession odds, while elevated, did move higher, still did not put us into a recession, we believe. Now we'll have to see, but we believe that cooler heads are prevailing and will avoid that recession. Regardless, we've seen in the near term increased inflation expectations. And that's another reason why you've seen stocks move a little bit lower here for the month of March. If inflation moves higher, that really eats into our wallets and can just delay any further Fed hikes. So what I'm painting here is really that yellow bar of where the conflict started. And then you see inflation expectations for 5 years from now move from about 2.4 up to 2.6. So not a drastic increase, but nonetheless, it stalled, did move higher, kind of moved in the wrong direction of what the Fed would want to see. But on the flip side, years 6 through 10 from now, what we call the 5-year forward, has really kind of stayed anchored or moved lower. And what that tells us is that this is a short supply shock. We will move through this, and any inflation 6 to 10 years from now will really be benign and actually maybe move lower if it does increase the recession odds. So we get kind of a mixed bag here, but for the most part, one thing I talked about at the beginning of this year is a major tailwind is Fed cuts and the One Big Beautiful Bill Act putting more money back into our pockets. Now, those two things I think are kind of stalling out at this point. Another reason why you've seen stocks move lower here to start the year. One of the big reasons is the Fed chances of Fed rate cuts have really moved from about 2 to 3 as that yellow line points. You can kind of see we're in between 2 and 3 there for our major kind of market prediction futures markets and just outright prediction markets. But once the war started, moved materially lower, maybe down to 0 to 1. For the record, the Fed still does expect one interest rate cut for the year. They didn't really change their stance on that when they had their Fed meeting, but we'll have to see really as the year progresses what happens here. So this will change over time. I like to update this every month for you guys, but that is one tailwind that is not really a tailwind anymore. If we can get back up to more cuts and avoid a recession, that does become a better tailwind for stocks and put this war behind us as well. Get gas prices to come down. That way it doesn't eat into our consumers' tax savings that we're getting from the Tax Act and the tax refunds. So there's some things that definitely in a month from now will be a little bit different, and we'll definitely share that with you. Now, the good news is, as I wrap up this video, is this is kind of an outlook. Even though despite all this volatility in in the markets and the headlines and the wars and the price of oil and the price of gas, Wall Street analysts have still moved up and increased their earnings expectations. Or I put another way, they're moving higher. If you look at the slope of the top blue lines, which would be 2026 and 2027 expectations for corporate earnings, they are moving higher. Just to kind of point this in the upwards and right direction, that is potentially good news for stocks, as stocks tend to follow the earnings of companies. So despite all the volatility, analysts really have looked through it. They said, we still believe double-digit earnings growth for stocks this year. And I think that's another reason why stocks did not sell off as much as maybe what they could have historically. So um, we will wait and see. We'll wait to see and hopefully put this geopolitical risk behind us, as it does always create a lot of headlines. Most often, these headlines are just pure noise to distract us, to distract long-term investors. As history does show in this chart, the market does move higher in the long run, despite all these political wars that happen across the world. Wars we're involved in, not involved in. It doesn't matter. You see a little bit of short-term volatility, but overall, stock markets tend to move higher over time. They look at corporate earnings, they look at GDP growth, and that's really what matters in the long run. And the good news is what I shared with you last slide is those are moving higher. Corporate earnings are expected to move higher for the year and move higher for 2027 as well. So that's the good news for the outlook. I think the quicker we can put this behind us, which I think we're getting close to, we can get back to all-time highs in the stock market for the rest of this year, but we'll have to wait and see. So, a little bit of volatility to recap in March, and then we believe April will be a better month as we kind of put this behind us and move forward with the focus on corporate earnings and, of course, getting closer to midterm elections, which we'll definitely keep an eye on here for the next few months. Again, thank you for watching this video. And thank you for your trust. We approach the management of your complete financial landscape very seriously as a trusted steward, advocate, and confidant. We're completely committed to you, the client. Please reach out with any questions. We hope you like this video. You can always email us at retirepathadvisors.com. Give us a call, give your financial advisor a call. You can always reach out to me, Case Eichenberger, the CIO, directly. And of course, view our website for more thoughts on any blogs that we come out with. I tend to write quite a lot, and there's always some good commentary out there on what's going around in the landscape regarding markets and the economy. So thank you again for watching. We hope you have a wonderful start to spring and have a wonderful Easter holiday celebrating with friends and family.